China has no bigger supporter on Wall Street than Ray Dalio. And even this bullish investor in Chinese stocks is having to rethink in face of the ongoing economic turmoil in the world's second largest economy. Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, has sold his firm's entire holdings in 5 Chinese stocks, including the e-commerce giant Alibaba, from which he unloaded almost 7.5 million shares as of June 30th. This move is coming less than a year after he launched China's biggest single fundraising effort, a feat that saw him collect $1.25 billion from Chinese investors and eclipse a competitive offering from the world's largest asset manager, BlackRock. So what could have changed? Is Dalio's recent drastic move entirely based on the unfolding situation in China? Or could there be more behind this rather puzzling call? Stick around as we unravel why China has lost its biggest Wall Street supporter. Ready? Let's dive in. Ever since his first visit to China in 1984, Dalio has been a champion of Beijing, even with its one-party leadership system. But with China's economy presently being besieged by an unprecedented mortgage crisis, one that is increasingly threatening to plunge the world's second-largest economy into its biggest economic recession ever, Dalio has taken the rather drastic step of selling many of his holdings in China. Going by a recent regulatory filing, Bridgewater Associates no longer holds stocks of Bilibili, JD.com, NetEase, DD Global, and most notably, Alibaba Group Holdings. Dalio's Bridgewater Associates, which runs a $236 billion hedge fund, has a $6.2 billion all-weather China fund, and has recently liquidated positions in 5 of China's biggest companies, worth $1.02 billion as of the last quarter. Dalio also trimmed his stakes in 32 other Chinese companies in the 3 months preceding June 30th. However, he continues to be a believer in Chinese Tesla challengers like Li Auto, Xpeng, and NIO, adding even more shares of these companies during the last quarter. With the stocks of NIO and Xpeng climbing by 19% and 65% respectively since the end of September 2021, Dalio has boosted the value of his investments in these companies likewise, boosting his investment in NIO to $120 million and Xpeng to $68 million. Bridgewater also continues to increase its stake in Baidu in the most recent quarter, moving its shares in the company up by 1.5% increment. These increases in Chinese stocks by Dalio have led many analysts to speculate that these stocks that he most recently dumped could soon get picked up again, and even much quicker than expected. Similarly, Dalio has maintained his stake in a few other Chinese companies, like Tencent Music Entertainment Group. Bridgewater holds over 3 million shares of the company, a position that remains unchanged in comparison to the previous quarter. Dalio's liquidation of his holdings in these companies is stemming from the SEC's recent regulatory crackdown in the face of China's looming recession, as well as the continued and heightened delisting pressures of the vast majority of Chinese firms traded on U.S. stock exchanges. China's stock market and its international indexes slumped massively in the 3 quarters leading to March 31st, wiping out a total of $757 billion in market value along the way. With the MSCI China Index of 715 Chinese stocks and the Nasdaq Golden Dragon China Index gaining 2.5% and 12.6% respectively in the last quarter, it appears Bridgewater quickly took advantage of the small rebound in the market to sell. Dalio, in a LinkedIn post on August 9th, described the escalating tensions between the US and China over Taiwan as being highly dangerous. According to Dalio, this continued tension has sent its conflict gauge to its highest point ever and necessarily calls for urgent action. This was especially after China conducted live-fire military drills around the island of Taiwan following Nancy Pelosi's visit. The cross-strait tensions around Taiwan's territorial water borders have especially added to the delisting risk factor that's presently facing over 270 Chinese companies that are traded on U.S. stock exchanges. The SEC, in a recent press release, expressly stated that several traded Chinese companies, including Alibaba, have been added to its watch list for possible removal over audit inspection access. Bridgewater's portfolio, according to its recent filings, has seen a 4.8% decline in the value of its global equity investments as it fell to about $23.6 billion. From other indicators, Dalio and Bridgewater now appear to be focusing on new, non-Chinese additions after buying a $31 million stake in Sea Ltd, a Singapore-based technology firm, and spending an additional $16 million on Amazon shares. Alibaba was one of Dalio's most valued positions in the second quarter, only second to the billionaire's position in Procter & Gamble. His entire stake in the company was valued at $813 million before the liquidation. After losing a lot of value for most of the first quarter, Alibaba stocks would eventually go on a 6-day 69% rally from the March 15th low, while the stock climbed by a further 71.7% to its second quarter high in June. Alibaba stock came under renewed pressure, forcing Dalio to liquidate his position in the e-commerce giant. From a macro perspective, the recent economic data out of China has likewise not been very inspiring. While Dalio has always been bullish on China in the past, he saw the writing clearly on the wall, especially as the situation showed no tangible sign of improving. Amidst delisting fears in July, Alibaba tried hard to deal with the messy situation it was in with the SEC, as well as reassure its investors. Unfortunately, the company's stock struggled for upside traction and failed to appreciate considerably. Dalio's dilemma with Alibaba now turns out not just to be limited to the increased pressure the e-commerce giant faced from the SEC, but what appeared to be a countrywide issue, especially as many other Chinese companies faced potential delisting threats as well. To put this in perspective, DD Global, another Chinese firm whose 8.2 million shares Dalio likewise liquidated, was recently forced by Chinese regulatory pressures to delist from the New York Stock Exchange and is recently relegated to trading over the counter. These pressured Chinese companies have been increasingly feeling the heat both from Chinese regulators and the SEC. China has especially been increasing its regulatory scrutiny over high-profile Chinese tech and media companies, particularly the ones listed in the US. In a similar manner, since the passing of the Holden Foreign Companies Accountable Act of 2020, Chinese companies have faced similarly high regulatory pressures. This act specifies that the U.S. can ban the trading of securities of companies whose auditors can't be inspected by the America Audit Watchdog for 3 consecutive years. Dalio has dumped his 2.1 million shares in JD.com, the 1.1 million shares he held in Bilibili, and another 370,125 shares of NetEase, which he owned for this same reason. Aside from Dalio, a lot of other American investors are fleeing away from these companies in droves, especially with the unrelenting economic slowdown in China and the continued geopolitical tensions. While Dalio is yet to personally comment on the reason for his fire liquidation of these stocks, Wall Street analysts continue to draw inference from Bridgewater's 13F filing. China's ongoing real estate bubble and mortgage crisis did invariably add to the pressure for Dalio. Dalio, in another of his statements on LinkedIn, has expressed that while Wall Street is paying more attention to the age-long rivalry between Washington and Beijing, the ongoing tensions between both countries over Taiwan are following the classic path to war. As Dalio was quick to predict, U.S. securities regulators are already forcing Chinese companies to delist from U.S. financial markets as long as they cannot independently verify the quality of their audits, with this regulation capable of affecting nearly $1.3 trillion worth of stocks. It remains to be seen if Dalio would liquidate more of his holdings in Chinese companies, especially if the ongoing mortgage crisis and the heavy crackdown by Chinese regulators persist. But a growing number of Wall Street analysts are predicting that this could be the case. The prospects of investments in China will be further covered in doubt if the brewing tensions over Taiwan are not quickly nipped. Make sure to give this video a like, hit the subscribe button, and smash the notification bell to receive updates on when we post more intriguing stories about global finance and investing.